Good afternoon and welcome to the Dairy Signal. We are happy to have you here on this wonderful Thursday afternoon. Today with us we have Ben Buckner, Chief Grain and Dairy Analyst with Ag Resource Company, to give you a market update. Just wanted to remind everyone to take advantage of the next hour with Ben and ask your questions. With that, I am going to hand it over to Ben and see what's happening in the world of markets.
Well, thank you so much, Amber. Welcome, everyone, 2026. We'll jump right into it. And I think from a very high level, there's not a lot new going on. So, especially since I think our last signal, the last couple of dairy signals, everything looks kind of the same to us. And so, what we spend our 200 man hours per week doing at Ag Resources, kind of trying to identify what's next. With everything that we see now, it's tough to even do that. There may not be anything terribly exciting until we get maybe into the Northern Hemisphere growing season. So, kind of prevailing trends are dominating still. I guess the only new thing that we all have to contend with is kind of elevated geopolitical risk. The U.S. Grabbing Venezuelan oil, Ukraine, Russian peace talks, but we see no sign of the end of attacks there. And it does seem like Russia and Ukraine both are kind of being very precise in their drone attacks. So we can kind of see and feel that Ukraine's exportable potential is in retreat. They're at very small percent of total corn, wheat, and vegetable oil export capacity today because of damage done to some pretty key ports. Beyond that, though, it's always number one is weather. We don't see a lot of interesting weather patterns where it matters most. We'll call that the Southern Hemisphere and equatorial latitudes where wheat harvests are maybe just 45, 60 days away from now. So I think it's the same kind of theme from us, whether it's U.S. production updates since our last meeting, world production updates. We've kind of now caught up with fine-tuning monthly U.S. dairy product supply and demand, and there's not a lot interesting there either. So our concern, and to start this out very, very clearly, actionable advice and so on, is we still like hedging milk output on rallies. Spot prices are not great, but when we look at the forward carries, kind of the back end of the market, I think the risk is, barring something unforeseen with respect to global production, is the forward markets, let's call it June onwards, will come down closer to meet the spot market. And I think that is, as of now, we'll revisit this every 2 weeks, but that's, I think, the risk to the U.S. dairy operation in 2026. But you think about P&Ls and balance sheets, I mean, we still do very much like doing beef crosses, maybe indefinitely. We'll kind of touch on what's happened in the beef and beef cow markets, but even there, not much. I think seasonal trends have dominated. Those trends turn positive after the next 60 days, and the market's already recovered quite a bit. And there's still no indication that we're solving the US's beef supply issue, despite the help of the dairy farmer. So that is, I think, very, very good revenue on top of milk production. Feed also stays cheap. So I think that we're getting towards, really in Brazil, the kind of final stages of the growing season there, and everything which is pretty routine, pretty normal. And you look at percent of normal rainfall, everything looks good. And it's very uniform. So the entirety of the 2,000 miles from north to south that spans the Brazilian soybean belt, everyone got a lot of water. Harvest is starting now, technically, and probably in places like Mato Grosso, the largest soybean producing, political boundary on earth, they will get to 50% harvested by February 5th. So new physical supply is coming at us. So the protein meal markets has got to deal with a lot of new crush capacity in the U.S., the return of, seasonal return of crush production in Argentina and Brazil, by March 1st. So there's really just no end in sight to that market being oversupplied, I think. And that's also, we start the new year, we think about general trends and macro economies, and we're still concerned about, real wage growth in the U.S. and a lot of the developed world, food consumption and how it relates to consumer spending, et cetera, and then just general inflation trends. So, in our head, it's higher prices cause inflation. There's no magic inflation that exists in the background, and so money gets put to work in the ag markets. But we kind of start at the top and think about crude oil fairly priced between $50 and $60. Stocks are adequate. There's no sign of U.S. production of crude slowing or OPEC. So it's just hard for us to envision 2026 being a year defined by raw material inflation if you've got crude oil between 50 and $60. It's not bad for biofuels, but it's not good either. And so just kind of the cascading impact of fairly cheap energy is something I think that keeps a lid on commodity inflation moving forward. But getting right into the milk markets and supply and demand. I think one thing we have seen in the last 30 days is the cash milk price nationally and in Wisconsin at $19.70 a hundredweight. Of course, kind of following trends lower, markets loosening, no doubt. We can all see and feel that. But there still is this $2.50 premium in the all milk cash price when we compare that to class three. And that's as of November now. And despite class four fat markets being very, very weak. So I don't know how long this continues, but I suspect for the next couple of months, we're going to see something like $18 to $20 national average cash milk prices. So it's not all doom and gloom when we think about milk revenue. I would prepare for ultimately kind of a test of $17 to $18 all milk cash prices, the end of Q1. But for now, I think the market's kind of hanging in there. It's kind of surprising to see that this premium is intact. And nationwide, all the major producing states are seeing similar levels, everywhere from $19.20 to $20 a hundredweight. But risks have not changed. And so we think about really the big picture of 2026 and drilling down into what's happening today. Milk production in the U.S., if anything, is expanding further. It's not contracting from the pretty sizable levels we've seen the last couple of months. So all milk production nationally in the month of November was 18.9 billion pounds. It's up almost 5% year over year. The cow herd is up 215,000 head from last year. It's 9.6 million or so. It's down a little bit from the month of October, but I doubt this is the beginning of a trend given what we're seeing in beef and beef cow market. So I think that is the kind of the simple risk when you think about, is there going to be a major change in really any of these markets, but isolating milk and dairy products? I suspect we're going to have this very large milking herd for the foreseeable future. And it's this weird kind of cycle where you think about the higher the price of beef and cattle go, the more support there is for keeping something like 9.6 million cows in milk, probably throughout the rest of the calendar year. So that just gives us a base that if you have even yield fluctuations in milk from month to month, you're going to be growing milk production guaranteed for the first half of 2026. So there's going to be a lot of supply. But we have talked about in the signal too, is trying to give everyone an edge. That really does dominate at least global cash dairy price discovery. If you had to pick one thing, it's just, is production growing or shrinking and at what rate? And that determines whether you enter a bull or bear market when we look at flat prices of things like cheese, butter, and even milk. Supply is going to stay large, I think, probably through the rest of the calendar year, but certainly through the first half of the year. And this is what we talk about when we think about the beef market. So there was a pretty sizable correction as we got the federal government kind of proposing ways to band-aid over supply issues, whether that's ending tariffs on Brazilian supply or importing sizable pounds of Argentine beef. But none of that really impacted U.S. beef supply and demand. So one, it makes us, or confirms that what we do here is, it's still all very much fundamental when you're talking about price discovery beyond the course of a couple of weeks. If you do not increase beef supplies, the beef market's not going to break. And so that's still the dominant theme. And every single month we get cattle on feed reports. Nothing really changes. They're all almost exactly the same. And so November's was as well. Think about December 1st cattle on feed down 2% from last year. Placements in the month of November were down 200,000 head. And cumulative cows placed on feed to be slaughtered for beef, through the end of November, we're only 19.2 million head. That's down 7% from last year and the lowest since 2015. I suspect in a couple of weeks when we get the December cattle on feed report, it's going to be very, very similar. Total on feed numbers down slightly, placements down, marketing's down. So things seem to be constricting here. I don't know if we're going to see the outright fear in the market to drive, spot Chicago live cattle back to 245 or 250. But I think the market's pretty fairly priced between 220 and 240. And you kind of see here that the recovery was just as quick as the break. So beef revenue stays in place for the rest of 2026. And we very much like this to offset, eroding milk prices. And this is, I think, kind of explains more so than geopolitics or potential US policy. The break in November tends to happen every single year. So I think that's mostly what that was. Maybe it was accelerated or exacerbated by US policy potential, but we're just kind of following the trends of recent years very, very closely. Now, you get a market that's very, very tight of supply, very highly priced. You know that small changes in the perception of supply and demand have an outsized impact on values. It's the opposite of when you're in a bear market. So if you were to think about cattle on feed, missing analyst estimates or something, you're going to see a big move in cattle prices. And there will no longer be small moves on a monthly basis in cattle and probably beef. But I think the bullish supply and demand trend does continue through the rest of the year. Milk production, though, again, just more of the same. We're not seeing any sign of contraction in our competing markets. And keep in mind, too, we've highlighted this off and on, but the price of farm gate milk in New Zealand is down just a little bit from the fall peak, but it's still about 19 cents per pound, which there is close to a record level. So it seems that the tightness in the butter market globally that we've seen lingering in markets like Oceania, and so the markets there are incentivizing producers to expand the cattle herd as best they can, to maximize all pasture land and improve yields to make that revenue. So I don't think that changes in the next quarter or 6 months or so. So we're going to have to deal with increased competition for things like butter and powder into Asia from New Zealand. Again, the message here is there's a lot of supply, and there has been for the last 6 months, but we just don't see any sign of that changing for the next 6 months. And that's why, of course, this is important. Maybe we'll show this every 2 weeks, but if you're expanding exporter milk production, it's very, very hard to rally the flat price of milk in the US or globally. So until we see some measure of not contraction, but the expansion starts to slow or become less intense, I think milk prices are more or less stuck at current values when we look at the spot market, at least. We also, though, do kind of we can paint the picture, the big picture for calendar year 2026, or at least the USDA, in all their wisdom, have put their heads together and given us, twice a year they do this, the annual supply and demand of global dairy products. None of it is terribly insightful, but I do think that none of this changes the trends that have been prevailing for the last couple of months, and that is, a fourth consecutive year of total exporter milk production growth to the tune of 600,000 tons. And so the USDA thinks that European production expands a little bit, Australian production recovers, and New Zealand production will be unchanged at very high levels through the 12 months, ending December 2026. So again, we're not looking at, I think, supply or balance sheets tightening. Best case scenario is that wheat prices start to discourage production and leave balance sheets stable. But again, just kind of, as gloomy as some of the long-term outlooks is, we do want to prepare people, because when you get recoveries or rallies in the milk markets or the feed markets, you know exactly what to do with them. And there will be periodic recoveries. The milk market's also subject to oversold charts and even speculative short covering. And so when those happen, though, we want to make sure to take advantage of that. I thought what was interesting too is, and we've kind of highlighted this the last couple of months, is Argentina is recovering very quickly. I think it's partially, probably mostly because of weather. It's kind of interesting how much of this is driven by weather and solely weather when we think about the ag markets. We're kind of coming out of consecutive La Nina events, major drought ending 2024, but also relative currency stability. I think that's helping the farmer make future plans. Argentine milk production has been very, very good the last 6 months, up 9 to 12% year over year. And the USDA thinks, I think rightly so, that continues. So Argentine milk production and cheese exports in calendar year 2026 will be the highest on record. Milk production will be 12 million tons. It's up 500,000 from last year. And you kind of see that the weather currency issues of 2024, 2023 have been solved completely. And that's been a message, I think, of the global dairy markets the last 6 or 8 months, is the problems that were numerous and intense from the ultra bull market of 2022, 2023 have been solved by high prices, and that does include Argentina. Now, I do think, unlike a market like wheat or even soybeans to some extent, we do benefit from normal demand growth. We think about the how in vogue protein is. Protein, protein, protein. So the USDA is projecting total global dairy product disappearance at a record 45 million tons. The trend is pretty clear. This population, sort of the health benefits of dairy can exacerbate this, in given years. But 1.6% growth, that does beat the 5-year average of 1.3%. So it's not terribly exciting, but there will be more dairy consumed in 2026. And I think that's kind of locked in. When you think about a company like Starbucks now advertising high protein foam for your coffee, there's certainly something to this. And the USDA's proposed new food pyramid is heavily or more reliant on protein and fat. Think about full fat or 2% milk being served in schools starting the school year beginning this autumn of 2026. I think that's going to be a big deal on balance for the disappearance of fat and fluid milk. So it's a positive thing that the world's kind of coming together, and some of this has been building for many years, but I think dairy is viewed much more positively than it has been, 5 or 7 years ago. So this is the positive. We're going to produce a lot of stuff, and again, that dominates prices probably for the next 90 days. At the same time, it's not going to be terribly difficult to clear inventories. So that's what I say. The markets have found equilibrium. What's next? So we think about just too much milk being produced, but at the same time, we're going to make a lot of this stuff disappear and pretty easily, especially at $15.50 a hundredweight class 3. I think the market's completely fairly priced, but what's next, I think, is the question we can't answer. Probably not much for the next several months. I also thought it was interesting that the USDA thinks all product consumption growth will happen simultaneously. So this is not very unique to the cheese and butter markets. Butter demand globally is projected to grow by 3%, cheese 1%, but non-fat dry also up 3%. And so it recovers from the doldrums we've seen from the last 2 years. A lot of this is Latin America, kind of Mexico exclusively, which is great because they're a neighboring market that we beat everyone on in terms of freight. And China even projected to not really grow, but stabilize. So I think the future is brighter for at least milk powder demand in 2026. So you think about the demand side of the ledger, and it all looks fairly bright, all things considered. The issue, though, is we still, get thrown back into equilibrium. So you kind of talk yourself into circles. We think about butter, New Zealand, solely because of production growth there, the incentive to sustain production growth, they're going to recapture the share of world trade that they lost the last couple of years. And I think this makes perfect sense. We've even seen in New Zealand census data that they're kind of back doing what they were doing 2 years ago. So I think butter exports through at least the end of October are up something like 30,000 tons. So they can see this high price of rolled butter. They're producing more milk and more butter. They're capturing this market share. And so that continues. So the U.S.'s share of butter trade rightfully forecast to decline back to 8% from 10% in calendar year 2025, which just kind of adds to butter's woes. It's a lot of fat available now. We are guaranteed to build U.S. butter inventories from January to June. Exports probably help out a little less in the U.S. over the next 6 months. Cheese is different. So cheese demand globally grows by 1%, and the U.S. should expand its share of world trade. And that makes sense just given the snapshot of cash prices today. We're going to be producing an incredible amount of cheese in the US in 2026, to the point where it's hard to be very bullish of cash cheddar prices. But at the same time, I do think exports will kind of make something like 100 million pounds disappear every month. And we're seeing that in the latest census data. So the US expanding its share of cheese kind of makes us think about one, class 3, I think, again, finding equilibrium at $15 to $16. A few months ago, we weren't sure that $15 would be the bottom in class 3. And there still is the risk that at some weeks in Jan, Feb, and March, maybe you can see $15 even, $14.85. We just know seasonally it's the wrong time of year for cheese and milk prices to go up. But thinking about the demand, we can't at this point really afford much milk production loss, or at least to some extent. So again, I think that cheese completely fairly valued from $1.45 to $1.65. Call it class 3 something like $15 to $16.50 per hundredweight. When we look at the nearby market, cheese demand in the U.S. will be growing. Exports will help this. But I think that makes sense, and we're kind of seeing that today. And not only have we seen, I think it's important, although very nuanced, The cheddar markets in Europe and Oceania have not been going down the last 30 days. And so they have access to all information the US market has, their own domestic supply and demand. European cheddar for the last 30 days has been pretty stagnant at $2.20 per pound. New Zealand back and forth, rallying some weeks, but this week unchanged at $2.11 per pound. The US market at $1.45 to $1.50. The cheapest origin on earth, and if importers want to save money, they're going to keep going to the US market. I think, too, when we kind of drill down into this further, looking at the graphic on your left, just world prices is one thing, but we want to look at the spread as well. So on the right, you see the spread widening. So US cheddar is priced 75 cents per pound below the European market and 65 cents per pound below the Oceania market. Those are new 3-year highs in those spreads. So we found, and you can see this in the data, that when cheese is cheap in the US, exports go up. Cheese is cheap today, so I think exports will continue. And there's even more incentive than there was 2 weeks ago to import US cheese over all other origins. So I think that is interesting and provides some pillar of support to the milk market. We finally have enough production and stocks data to fine tune, kind of back into actual monthly disappearance through the month of November. Cheese production, American cheese production, was 473 million pounds in November, up 3%. Stocks, though, were up only 2%. And so when we look at implied disappearance, it was an incredible 501 million pounds in the month of November. And I think part of this growth is still the export market. So that's a disappearance, 501 million pounds, up 10% year over year. Not seasonally lower either. So that's why I mentioned at $15 class 3, $1.50 cheese, we're going to make a lot of the stuff disappear and disappear pretty easily. So there is demand growth in place in the cheese market. And this kind of explains, I think, market action the last month or two more than anything else. Butter disappearance in the month of November, it's kind of surprisingly weak. We're kind of matching 2023 instead of 2024 levels, and seasonally was lower than it was in October. So we kind of back into monthly butter demand, 211 million pounds. That's down 17% from last year. And again, looking at the weakness in the global cash markets, higher New Zealand production. This is still fairly strong demand, all things considered, but it's just not enough when you're producing, 9, 12% more butter year over year, like we have seen really since the month of July 2025. So that explains why cash butter today, nationally average in the wholesale market, $1.33 per pound. US butter is cheap, but it does seem to be telling us it's not cheap enough, or there does not exist the demand for US butter today to offset this stocks building period. And unlike cheese, when we want to look at on the margin movement in foreign cash markets, you can see the kind of pronounced weakness everywhere else. And on a percentage basis, it's been Europe and New Zealand that have been most weak since the early part of October. So everyone's got this butter. They need to find ways to clear excess stocks, and it's that competition that keeps butter prices depressed, fat prices depressed, I think, in our research. But feed market's still the silver lining very much. And so, again, what we want to communicate is class 3, fairly priced. Not a lot of hope for strength in the next 2 months, I think, but we're not as bearish as we were. Feed markets, though, I think income over feed cost may decline a little bit in the very short term, but probably stabilize when we think about the next 6 months. Again, South America's growing season, at least in Brazil and with respect to soybeans, is nearing its end, and they avoided weather threats. Argentina still has about 6 or 8 weeks to go, but everything looks very good. Up to date, soil moisture abundance is widespread, and there's really no real issues in the forecast in the next 10 days, 14 days. Drought forecast to ease in the Pacific Northwest U.S., winter wheat belt, and across the eastern Midwest. And I think that's what we're seeing even in 10-day forecast. We've seen this really rapid erosion across the Pacific Northwest when we look at drought coverage and intensity. Got a lot of rain, maybe some snow on the way, kind of east of the Mississippi River, to the point where a lot parts of the Southeast and Mid-South get maybe 4 inches. That will eliminate droughts in places like Arkansas, Tennessee, maybe even Missouri and eastern Iowa. So soil moisture issues, famous last words, probably not going to be a big deal come planting in spring 2026. We also don't have any details about U.S. biofuel policy. We're kind of waiting on carbon scores. What exactly do 45Z credits do and for whom? What will the final volume mandates be for renewable diesel? And how much of these small refinery exemptions will be reallocated to large refineries in 2026? We have no details surrounding any of that. There is a potential bull story in soybean oil if many of those exemptions are reallocated and the volumes expand by 30 or 40%. And 45Z make sure that you have to use domestic products to meet biofuel mandates, but we just don't know the details of that. China's buying of US soybean also, we're thinking it's kind of getting to the tail end. And so what we have been able to chase down really the last 90 days is China. One, our friends there say that they are committed to buying the 12 million tons of US soybeans in this crop year. They've bought something like 10, maybe 11 million tons to date. So it's very positive, but also, again, maybe a million and a half tons left. Then everyone shifts to South America to fill their import needs. We're also not hearing any confirmation about the 25 million ton commitment 2026 onward. That wasn't a very robust commitment anyway, but they're unsure where that comes from, and we can't really count that as fact just yet. So I think the soybean market and the protein meal markets are going to have to contend with the end of China buying U.S. soybeans, and also just a normal seasonal shift because Brazil's soybean crop will be very big. It's offered very cheaply. We're probably going to lose soybean market share pretty quick after February 1st. But everything looks pretty reasonably priced. And again, I think current milk to feed ratios will fluctuate, but more or less be stable where they exist today for the next 12 months. Not since 2017, in the month of November, have we seen all hay priced below $151 per ton. This is an 8-year low for the month of November. I think seasonally probably drifts a little bit lower in December, and probably not a lot of strength in the winter, early spring, given our ideas for U.S. soil moisture. Even today, places like Kansas, Nebraska, Texas, historically very normal to surplus soil moisture. So I think hay prices or hay production looks pretty solid in 2026. And this is our least favorite graphic to show, but we did want to revisit this and just thinking about the feed market as a whole, the physical cash feed market across the spine of the central US. And nothing's really changed. China's even been buying, periodically pretty substantial tonnages of US sorghum. We're making more than we thought of hard red wheat disappear in the export market, yet the cash market's telling us there's still way too much of this stuff, and the market does not want us to plant any more of this stuff in 2026. So, cash wheat in Garden City, Kansas, still $4.30 per pound. Cash sorghum in Hays, Kansas, still about $3.10 per pound. It's very cheap. That's going to displace corn and feed rations. And you just think about the amount of feed that exists in the central US. There's a lot of it. It's going to be hard to change over the next 6 or 8 months. So those markets are going to have to be priced to sell. They're going to have to go to a level that encourages, livestock and dairy operations to buy the stuff. And I don't think any of that changes in the medium term. Wheat's still the dog of the ag space. And I wanted to show the monthly chart because we talk about, opposite of live cattle, when you have very small changes in the perception of supply and demand, have a big impact on price. When you have a market like wheat, for example, and maybe corn, soybeans forthcoming, adequately supplied, not expensively priced, you lose for one volatility. So our idea, I think, on corn, soybeans, and wheat, it's hard to have an opinion. We're not really overly bullish or bearish this stuff, but our insight would be nothing probably changes in a meaningful way in calendar year 2026. We think about soybeans, think about wheat and corn prices. What we've seen for the last 12 months, barring weather events, happens for the next 12 months. So you can see here, the wheat markets have been fighting over pennies and nickels, really since the end of 2023. That is a function of oversupply. I also wanted to show you what's happening in the exporter wheat market. This does, I think, relate to corn to some extent. Argentina has been blessed with incredible weather since the middle of July. The wet season there arrived about 45 days early, which mostly benefited the wheat crop. That wheat crop reproduces in September. I think they're going to harvest this year 27 million tons of wheat. The current record is 24. They harvested 18 million tons last year. And so there is too much wheat in Argentina, and the cash price of wheat in Argentina is telling us that they have decided that this is a feed supply. They've got to clear a lot of excess wheat supply before April 1st when corn harvest gets started in earnest. And so you can see here that wheat in Argentina can be bought for cheaper than US corn at the Gulf. That will displace on the margin some measure of Latin America and Caribbean feed demand, I think, because these are substitutes in a lot of markets. But wheat is just very cheap. It's hard to be really overly bullish of corn unless you've got higher wheat prices. And so again, kind of like milk, you talk yourself into circles, and the end result is I don't think grain markets change all that much over the next quarter. But on the supply side, again, having avoided meaningful weather threats in South America is important. Physical cash supply availability will be increasing, not decreasing over the next 90 days. So we wanted to talk about Argentina. They are the next to harvest corn. It will start the first week of March and peak in the month of April. And this is September 1st to January 7th, percent of normal rainfall. Not all is perfect, but most everyone's gotten between 6 and 8 inches of rain in this period. Anywhere from 80 to 103% of normal when we look at the totality of the corn belt there. Kind of go northward into Brazil and everything looks between 90 and 130% of normal. It's been a very routine South American climate. And again, the growing season kind of in its last legs. Some 35% of Argentine corn was planted before, the end of November. Some of it was planted by the middle of October. That corn's pollinated and will be harvested in the next 8 weeks. So again, we're kind of moving to the point where you check off the box that you've avoided South American issues. Vegetation health is showing us that the crop potential at least is very large. On the left, you see vegetation health compared to normal. On the right, you see the updated 2-week forecast. So I think this general routine South American climate pattern continues into at least the second half of January. And after about February 1st, maybe February 5th, it's kind of like you're getting into the tail end of August in the US. It's just weather matters, but it's not going to have the impact that it would have should you have had weather issues in the month of December and January. So we think Brazil is going to produce 177 million tons, excuse me, maybe at minimum. Our team is now through 4 legs, going to be touring the entirety of the Brazilian soybean belt, finishing in the far south in early February. They're in the far north currently, where harvest is about to start in bulk. And they're finding at least very good potential, very high pod weight, some 4-bean pods, very, very thick looking pods as well. So again, having avoided issues there. I think the question that we've got now is, do we have to ratchet this up to something like 180 million tons? And at that point, China can import all of their needs, fill all of their needs with Brazilian soybeans, and Brazil would still have 10 million tons left over. So again, just thinking about the big picture of markets, supply availability, there will be geopolitical nuance. We've got to see what the U.S. farmer plants in terms of soybean acres. What does weather do next year? What is crush? What is biofuel policy? But South America is going to have an incredible amount of soybeans. And that's kind of the beginning part of our analysis of markets. And so I think it's going to be hard for the U.S. to grow its share of trade if Brazil does harvest 180 million ton soybean crop. And I just wanted to show you this. I think, again, this is the evolution of the crop cycle in Mato Grosso, which again by itself produces 2 billion bushels of soybeans. Last year was a delayed planted year, delayed harvest, but this year everything was pretty normal. So I think we're going to follow the black line. I think they will start reporting soybean harvest progress this Friday. It will be 4 or 6% complete. But notice that by February 7th, you're 55% complete. That will be about a little over 1 billion bushels of soybeans in the physical market, ready to be used somewhere, somehow or another. It may not have a huge impact yet on Chicago soybean price determination. That seasonal downtrend may wait until March or so, but just know there's going to be a lot of soybeans available to the world market in the next 30 days. We also think about, again, what's next in the markets. Will Mother Nature give us a surprise? And the more work that we do, 200 man hours per week, I think the big picture theme that we have found when we go through scenarios and we change acreage in the US for 2026, we change biofuel policy, the one number that really turns this thing around and tightens up US and exporter supply and demand is the yield number. So who knows what the Northern Hemisphere or Midwest summer weather pattern will be. We will cross that bridge the early part of June. But where weather does matter now, South America, Australia produced a very, very large wheat crop. And then equatorial latitudes. These places will start to harvest wheat, maybe the end of February, early part of March. This is North African rainfall from December 1st to January 7th. And it's just been surprising the abundance of rain that's fallen here. They haven't seen this much rain since 2020. Usually, this region's mired in drought. It just doesn't rain. This is the third largest wheat importing region on Earth. So we kind of dig into the numbers, and there's still some time to go. But every time it has rained at least 6 inches in Morocco in the month of December, you do have trend or above trend yields. So we think that wheat demand growth will struggle based on higher North African wheat crops. So you think about wheat being priced below U.S. corn in Argentina already. I think above something like $4.60 per bushel in Chicago. Corn is priced above Russian milling wheat. So just think about this as an anchor. And that's kind of our message, is there will be the normal debates the analyst community goes through like every year. But the edge that we want to give you is that there's just not a lot available to change the overall structure of these feed markets. So when markets go up, you know what to do with them. Also, when they break hard, you know what to do with them. I think strangling these markets makes the most sense. But here is just more evidence that North Africa is being blessed with a lot of rain. So too is the Middle East, the second largest wheat importing region. So we're struggling to find weather issues that would change sort of the tune of feed markets. And here's just kind of an exercise we've been through to highlight this. So every week we get the amount of wheat acres enrolled in kind of USDA sponsored programs for insurance. And this has been kind of a secret that we found. So if you plot this against the change in actual US winter wheat acres, it's very tight. The degree matters, but we know if RMA enrollments are down, so too is actual US winter wheat acres. And so we've seen that, as of the end of December, RMA enrolled wheat was down 1.5 million tons year over year. So we thought maybe the market's starting to do its job. We're going to plant a lot less wheat this year. Does that start to change the structure of US wheat supply and demand? So we have in this scenario cut wheat acres 2 million acres. Trend yields, trends in consumption, kind of assuming for now normal weather everywhere. So we have stagnant world market share, but you can kind of see that we're still left with in stocks above 800 million bushels. That to us is kind of still a $5 to $6 wheat market. And so it's the 51 bushels an acre number. That's what can change things. And so who knows what happens, but we can't even start to visit this number, I think, until April 1st at soonest. So in the next 3 months, we're kind of stuck where we are. The same thing with corn. And we've gone through this exercise before, but whether our stocks number is right or the USDA's number is right is kind of irrelevant to, you can take 6 million acres, 8 million acres out of the US corn balance sheet next year, and you're left with the same amount of in stocks unless something changes. The export number next year can change if there's adverse weather somewhere else. The yield number, of course, changes if Midwest weather adversity is prolonged this summer. But again, it's all kind of goes back to Mother Nature being ultimately the arbiter of this bear market peaking or not. So hyper attention on weather. And again, I think it's probably not until the Northern Hemisphere growing season begins that we can really start to adjust things. So with that respect, too, we're kind of thinking about, again, what is next? What will drive corn, soybean, protein meal prices meaningfully higher in 2026? And I think we've shown kind of hard to do that today without a weather threat somewhere. We're kind of looking at what the U.S. farmer does in 2026. And so we all know corn's been weak. We're going to lose wheat acres because the wheat market's been weak, especially the cash market. Soybeans probably have bought acres in November. That can be debated. But when we look at the kind of the whole structure of the major crop market in the US, cotton prices year over year already very cheap, but down another 5%. Rice prices, decade low and down 33% from where they were a year ago as of the end of December. So we think about probably planting less rice, less cotton. We know we're planting less wheat. Will there be 3 or 4 million acres across the plains and the Delta region that gets freed up to plant either corn or soybeans? And I don't know what works best for the farmer in central Kansas or in central Mississippi or Texas, but it's probably going to be either corn or soybeans, or those acres go away. That's not something we've really seen very often. So I think the risk is that our 92 million acre corn forecast for acres in 2026 Maybe it's 94 or 95 just because we've lost rice and cotton acres across the southern US. So that's, I think, one of our messages. Again, just talking yourself into circles. There probably will be more than enough acreage to go around for both corn and soybeans. Then it's up to a weather threat or biofuel policy. I think that we've thought about, politically, how does this turn around? And the lowest hanging fruit, of course, would be biofuel policy. I mean, why, in the laws of physics, there's no reason we can't do E30 or E20. That's all political willpower, though. And so we kind of entertained E15. Will that get implemented nationally, mandated for 12 months? That would use something like 20 billion, or that would require 20 billion gallons of ethanol production and use, this is nuanced, but something like 6 billion bushels of corn. Growth will be welcomed. But you can kind of see here that capacity is the constraint. This is an official number published every year by EIA, and at least as of January 1st last year, capacity was only 18.4 billion gallons. We think that a few additional plants will get added in the next 12 months, and so capacity does ultimately get to something like 19 billion. But you're still a billion gallons shy of what we think would be required to meet E15. So we need investments, time, and policy to really get this thing off the floor. And the same thing with crush capacity in the US. That is a major driver of soybean consumption domestically and does grow between now and the 24 months ending the 2026 crop year. But based on what we know and we kind of see, it takes years to get a plant online, and probably crush capacity can only grow by 100 million bushels or so in crop year 26, 27. So it's all good, it's all welcomed, but we need policy, we need investment. And I think in the case of ethanol, it's just today we can't produce enough ethanol to meet something like E15. And then thinking big picture, are we concerned, or should the market be concerned about general inflationary trends? And with respect to commodities and raw materials, it's very hard for us to embrace this unless you had a change to crude supply and demand. And so I think one of the issues is, of course, now we have 30 to 50 million barrels of Venezuelan crude oil, but even predating this, as of January 2nd, commercial crude inventories in the US were 419 million barrels. It's up 1% from last year. Every year, kind of like butter, we're going to grow crude oil inventories very fast, very intensely over the next 3 or 4 months. OPEC, no sign that production cuts will be meaningful in the first half of 2026. So crude oil at $50 to $60 per barrel does not really foreshadow to us commodity or raw material inflation. Again, thinking about biofuel margins, world demand growth, all of this is kind of portrayed in this chart, and crude oil is not expensively priced. And kind of lastly, we think about, again, what's next? Will there be a weather problem? And we don't know this. El Nino and La Nina are not terribly good predictors of US weather, especially in places like the upper Midwest and Great Lakes. But something we've noticed the last 12 months is that these temperature anomalies, so warmth is El Nino, coolness is La Nina, haven't been very intense. And I think that goes a long way in explaining why we've seen an absence of yield loss and weather threats in places like South America a year ago, South America this year, Australia, Southeast Asia. So Mother Nature's been pretty kind. And on the right, we've got our best guess as of now, sort of the model-based forecast for this ENSO. Will we be in El Nino or La Nina? And most likely between now and at least June or July, we will be in neither. So it will be the year of no Nina, neither La Nina nor El Nino. And so that kind of makes us assume climate normalcy, at least for the next 4, 5, or 6 months. I don't think there's going to be a lot of deviations from normal. So again, famous last words, probably not going to be a weather threat that drives markets between now and the early part of summer. So feed markets, again, to us, just very much stuck. And we don't have a lot of confidence in the details of 90-day weather forecasts, but this has been shown in recent rainfall, and I think upcoming rainfall, at least for the next 2 weeks. This is NOAA's drought forecast for the period ending February 28th, and you can see they've got an easing or an elimination of drought in the Pacific Northwest and a lot of places in the primary corn and soybean belt. So if anything, we isolate corn, soybeans, and a lot of winter wheat. Drought will be getting smaller, not larger during the winter. So again, I'm not sure if soil moisture will be an issue, at least at planting. So That was a long time to say just more of the same from us. Milk prices, equilibrium, probably won't rally because of supply. Same time, we've got a bullish beef market and neutral to bearish feed market. And so I think margins work, but be very proactive, selling the back end of the market. You can lock in margin. I would lock in that margin and again, pass this risk off on to someone else. So thank you for your time as always. And any questions now or at any time in the future are always appreciated.
Hey Ben, thank you so much for that update. We did have a question come through here, and it reads, during this period of reduced milk price, how do you see this record fat production prolonging the low milk price?
Yeah, I think for a while yet, there's really I don't know how fast you can kind of shut off the spigot when it comes to fat production. And what do you do with all this milk, I guess, is the big question. So I think it continues through the end of Q1. Then we'll kind of revisit this. I think there are odds that butter production goes back to unchanged year over year at a very high level. But I think it's going to take us some time, maybe 24 months to clear enough butter production in stocks to get us out of what we think is a range of $1.30 to $1.50 per pound. We've seen that in the past. It probably takes again 2 years before the next catalyst, whether it's new demand or production slows adequately, that things start to tighten. But certainly between now and the end of June, I don't think there's much hope for the butter market.
All right. Thank you, Ben. We appreciate all you do and to everyone at Ag Resource Company for their continued support of the Dairy Signal. We look forward to seeing everybody next week here and have a good weekend.